Welcome back to SMSF Mate's daily podcast. This is our general advice warning that we are required to warn you that any advice has been prepared without taking into account your objectives, financial situations or needs, and because of that, you should, before acting on the advice, consider the appropriateness of the advice having regard to your own objectives, financial services and needs, and where the advice relates to the acquisition or possible acquisition of a financial product, you should obtain a product disclosure statement, PDS, relating to the product and consider the PDS before making any decision about whether to acquire the product. Now let's get into it.
Welcome to SMSF Mate's podcast. SMSF Mate is where Aussie mates come together to get the most from superannuation and learn how to manage their retirement savings as best as possible. My name's Tim and I'm here with...
This is the Gareth voice reporting for duty.
And this is Ashwin.
Awesome. Today we're going to talk about insurance options within SMSFs and outside of SMSF and the various considerations that go along with that. So, yeah, welcome.
Insurance. Dirty word. Is it a dirty word?
For some.
For some. I think insurance, there's so many different types of insurance you can have for lots of different parts of your life. You know, you can have your car, boat, house, health. You can insure anything in theory, right? So I guess when you're thinking about super and non sort of self-managed supers, most funds I think include insurance kind of by default. Is that right?
A little bit. The laws have changed on that side of things. So a whole bunch of letters have gone out to people with the insurance policies within their funds to review, and sometimes they're cancelled if there's low balances and things around that. So it is up to each fund. I guess the thing I would say is you start off with what, just like you do with the car insurance or the boat insurance, if you're lucky enough to have a boat, is what
not
is
usually. It's budget out another 1,000 is what boat stands for.
Definitely. So I reckon it comes back to what you're trying to insure. So it's easy with health insurance to sort of work out, what you're trying to cover yourself for and what it includes. Life, income protection, trauma insurance, all of those insurances are around your, specific events that happen in your life. So some insurances can be held in super, some can't. So trauma, for example, is held outside of super, while income protection and life insurance and TPD could be held within your super fund, but sometimes it's advantageous not to have it in your super. So
and TPD is total permanent disability.
Disability, yeah.
Right.
And that's the key one, is sometimes why you might have it in super and not. In super is definitions. But even around that, the changes and the definitions within funds have actually changed recently, I think around October, around income protection. But again, go do your own research and see an advisor. But it starts off with the need. So, Gareth's had exciting news of late.
Congratulations,
absolutely.
Gareth.
I bought a new car. It feels like it. No, our little 4-week-old makes you sort of consider life on a different premise.
Yep.
Insurance, for me is something that I kind of believe you're insuring against, something may be happening, and basically you're taking a punt, or the insurance, company's taking a punt on you, and whoever's right wins. Kind of in the end, that's a very young person attitude, I think.
I'm gonna say that's
Ashwin's rolling his eyes at me.
That's an attitude pre-kids. I think for me personally, when we had our boys, or we had the first one, AJ, it was okay. All of a sudden, it's not me and Jody. It's not two adults trying to protect ourselves.
Yeah.
We've got a newborn that's going to need a certain amount of money through his life, and if something happened to me,
how are you going to fund it?
How are you going to fund it? And that's when most people do see an advisor to go get, the insurance advice and get the right level of insurance. Where I think it sometimes falls down is people don't change that policy. So you might say, let's say for argument's sake, it's $1 million is the number you come out with, which is what you need at a day Bub's born. What happens a year later if you made some money or you've earned a certain amount and there's more money on mortgage or etc. Right? So your life changes, and what people normally don't do is go in and see their advisor for a review and adjust the insurances. So for me, I'm at my highest insurance point right now. I've got 2 kids under 5. I've got actually one that's 5 and one that's 3. Until they're both a bit older, I'm going to need this level of insurance because there's a certain amount of years that I want enough money that Jodie doesn't have to stress about work.
Yeah.
The house is paid, etc. Right? For some people, it might be, they don't need that much because their kids are older and we don't need that level of insurance. Where people get mistaken is they take out that $1 million policy, they dot, and they don't change it till they're 60. So,
and just to flesh that out a bit, so the idea, or at least my understanding of it, is that your $1 million is to fund your children until they're basically capable of looking after themselves in the event that you either pass away or become
so whatever the event
you
is,
lose your income.
So if it's TPD, it's if I'm permanently disabled by the definitions of that policy
and unable to work effectively,
unable to work. Then there's obviously death. I'm no longer here. And then there's income protection. So all of those policies individually will have its own definitions.
And in simple terms, the idea is that the insurance company pays, your estate, if you like, let's say $1 million, and then your kids have $1 million to sort of.
My wife will.
Or your wife does, okay.
I wouldn't trust a 5-year-old and a 3-year-old.
Because that opens up a whole new thing about who the trustee is and who,
So insurance policies have who owns it. So I've got a business, and the other business partner associate in there effectively has an insurance policy on me. So in case I pass, she'll get paid out to pay my wife for the share of the business. So the business continues, employees don't lose their jobs, all the rest of it.
Sounds like a topic for another podcast.
Yeah. So, my concern is if my wife's not an accountant, she would not add any value to the business and would be in a bit of trouble.
And the business ends. Or in theory, it can't do what it normally would be doing.
This will give enough money for that person to find another accountant to come into the business and continue running as is. So that's the plan in my head. But that's all the different types of insurances that exist. So, and that's outside of super. You can have some in super, up to each individual of how they do it. But the key part is you really want to see an advice, because the product disclosure or the level of information in those insurances are pretty huge. So some people go to online websites, see a price. That's a guide, but you get loadings based on your health or your disclosures. So at the moment, I'm not sure if the camera's showing it, but it added about 20 pounds here, and that's an extra 50% loading I'm paying on a couple of my insurance policies.
Is it really?
Because of the weight. So
wow.
It is reviewable. So if I lose the weight, I can go in for a review and the premium will drop. So that's effective.
Yeah, so it's a lot more complicated than going online and getting some car insurance, right?
Car insurance. Fairly straightforward. Again, you still have to read the product disclosure documents, but it's general in nature and it's common in there, right? There's certain things that might not be covered in your policy. If you've got a family history of heart issues and things like that, they may either put a loading on it or they might even take it off as a restriction. But if you don't disclose it, you're not. So the key thing is do it when you're fit and healthy, because there's generally not a review again once the policy's in place. But you should also every few years review the level of cover.
Yeah.
So if the level of cover is still $1 million, but you just won lotto, probably don't need it anymore. You have people call you all the time going, well, why am I paying this premium? You're making that option to pay the premium. It will pay out if you meet the conditions of the insurance, but do you still need it? If you've got,
and I think obviously you've also got to kind of consider your lifestyle, right? Certain people live in different ways. And I guess if you have $1 million house with a $500,000 mortgage and then you want your kids to live in the same house, then you need to be able to pay the $500,000 somehow.
Yep.
But then if you live in a $10 million house with a $5 million mortgage, assuming you can do that, same applies, right? So, that number really probably needs quite a bit of thought.
Exactly. And the best place to go is there are guides, on certain websites to help you do a diagnostic effectively to work out what your level of insurance is. But if it was me personally, and that's what I did, I went and saw a financial advisor, sat down, we were sort of worked out the numbers, and then they handled the application process. So obviously I did the disclosures and
so they know what to ask and how to structure it and so on.
Did the blood tests, all the rest of the tests that they needed, and then go on from there.
And so from a self-managed super fund point of view, you don't have to have income protection and total permanent disability and life insurance in your super fund, but you can choose to have either or both in or out.
Yeah, there's no requirement to have insurance, but you'll find every super fund will have a disclosure around you've considered insurance every year and you've decided either to do it or not to do it, because it is a point to make a note to do it. So
it's the government's way of kind of making sure you've kind of thought about it in a way.
Yeah, and to be completely honest, you should. So because your mindset, Gareth, might have changed a fair bit since Bub.
I certainly learned some new words.
Yeah. And most people take the event of a child to go and get their insurances done. They just don't do the follow up and a review and keep an eye on it.
So they sit in the set and forget pile.
Yeah.
Meanwhile, they're paying substantial
amounts, and the premiums aren't huge when you're young. It just creeps up as you get older, and that's when people say, "Oh, why do I have this insurance?" So you go, "Well, actually, I needed that insurance when the kids were X. I don't need the same level insurance, so maybe from $1 million it goes to 800."
Right.
Yeah,
And
depending on how much
sort of scale it down over
you scale
time.
it down, and you can probably keep the premium the same. You also can technically you can also do a level premium. So at the start of your insurance application, it'll be the same premium effectively each year.
Right. And maybe you could expand a little bit on the difference between, say, income protection and total permanent disability.
Yeah, so totally impermanent.
Because it kind of sounds similar in some respects.
A little bit. So TPD is a lot harder to meet the criteria, so you'll be totally and permanently disabled.
Yeah, so car accident, jump off a building,
or
pushed off a building. Probably if you jump off a building, maybe not the same.
It depends. It depends also on the policy what's covered in there, right? So, but
before anyone gets any crazy ideas,
it's the outcome. But the key thing is that in TPD there's a definition called own occupation or any occupation. Now, if that's still around, you've got to go through your policies and see, do you need that policy? So let's say, for example, if you're a heart surgeon, you might have damaged something, but you're still able to work in other roles.
So you could be a GP but not a surgeon.
Then you might not be paid out. So it comes back to making sure you've gone through the process to go, are you covered for your specific occupation or any occupation? And that's sometimes what makes policies cheaper. And for some people, any occupation is fine, but for other people, they might want own occupation if it's available, and you go through those processes and see what's around.
And I guess the key is really in the name, right? Total permanent disability.
Yeah, well, income protection could be temporary.
Yeah.
You could do your, let's say you're a tradie, you do your knees, you're out for 12 months.
Yeah.
You've got a policy that might pay you for that 12-month period or the 2 years that it takes to
you're
recover.
Protecting your income.
Yep. You're protecting your income to a certain percentage. And that's the key side of it. So very different policies.
And can you have both?
You can have all three.
Right.
Right. And there's also another insurance called trauma, but that's usually it's held outside of super. And that's for a traumatic event. So something that meets that criteria, you'll get paid out on that premium.
Yeah. So in summary, your income protection, total permanent disability, death,
and there's a trauma insurance.
And then trauma. So you can have any one or any mix.
Yep. Your financial advisor will sit down with you and go, hey, are these the events? Yeah, these are the events you're trying to protect yourself from, and you can always elect not to do it.
Right. And is it possible to do it yourself?
It is, but you've got to read through those PDSs.
Yeah, right.
And
so you might pay a premium to see your advisor, but your advisor knows the loopholes, well, not necessarily the loopholes, but
they know what you need to declare, but they also know what policies might be best suited for your occupation. So there's sort of insurers that prefer medical people, certain insurances that prefer other people and might give you discounts. But ultimately, they also know they'll take you through that initial step of working out what you might need. Mm-hmm. And you might not be able to afford what you need, and then you make the informed decision to scale it down, right? Because that's where I started. You want to know what you need. Then you go, can I afford that?
Can you afford it? And then play
around, right?
And is it tax deductible?
Depending on the insurance and how it's held, yes.
Right.
It's all up to each.
So it is a bit more complicated.
It is very look, I went and saw an advisor for the peace of mind. I could have muddled my way through and applied myself, but going through an advisor gave me the peace of mind that there was someone else
who's checked it.
Checked it.
Right.
Also had the discussion with my wife. We both understand what we're trying to trying to achieve.
And I believe, Tim, there's an excellent article on our website about this, isn't there?
There is. We just put it up recently, and it runs through all the different types of insurances, as we've discussed. Considerations for inside super, outside super. Tax benefits related to each one. So, yeah, check it out.
And it's free to read.
It is.
No paywalls exist.
No.
There's a disclaimer, but there's no paywalls.
So on the income protection side, is there a benefit for having it within, say, your SMSF, or is it better to have it outside from a tax perspective?
Look, from a tax point of view, obviously most people have a higher tax rate outside of super fund. So if your insurance is tax deductible, the income protection, then effectively it would be worth more of a tax deduction outside. But also conversely, when it gets paid out, it's going to be assessable income in your own name. So it balances out. Personal view, it really comes back to more the definitions more than the income tax decision. So that's really why you want your advisor is to go,
right.
Okay, is the definitions or the types of policies available restricted because they're in super versus policies I could have outside of super, because there's certain definitions, certain terms that insurers might not be comfortable having or not allowed to use with a super funding policy, and that's why you go through it. And I'm not labelling it this way, but it's sort of what happened in the Royal Commission was they labelled a lot of insurances potential junk insurances, and that's where a lot of fines came out to people is, well, these insurances really weren't worth the money they were written on, so or the paper they were written on. So you would take the view, that's why you want an advisor, someone that actually knows, hey, that's the insurer, this is their definitions, this is maybe the rate of claims that they pay out, I've handled claims with that insurer. All of those questions are the key part, right? Insurance is only as good as, well, when I need to make a claim. So when you ask the question to an advisor, hey, if I go with X insurer, have you had claims with them? Have there been issues? And the answer is, look, most times they've been fine. It's easy enough to navigate through. Where they go, no, yeah, that one might be cheaper, but the process to make a claim has been difficult in time, and that might be their experiences, but that's the person you're getting advice from. So I would go through that person that's handled claims versus, Mr. Google, and I found the cheapest one. Because if it's no good when you make the claim, you don't have an advisor that's going to be making the claim for you. You've got your grieving partner trying to manage an insurance claim for you, which I don't know.
Yeah, so quite a bit more serious than a car insurance premium that might pay out $50,000 or something. These policies may pay out millions of dollars. So there's going to be a bit more research.
And some financial advisors will charge a fee. Some will take the commission from the premium, but ultimately they're there to navigate your needs when you need it. So it's effectively a fee for service scenario.
And it sounds like you really want to do your research on the advisor to make sure that they've got some experience and and credibility long term. If you see someone who maybe won't be around in 5, 10, 15 years, how does that work?
Look, I think the 5-10 years potential is let's say it's an older advisor you've seen. It might be a concern, but also that person's also got a wealth of knowledge over years.
Yeah, sure.
So
there's a bit of a trade-off.
It's a trade-off. But ultimately, they will sell their practice, obviously, prior to retirement, and that insurance will still be in place.
Yeah,
so
right.
So
it's not connected to the advisor, and so
it's connected to So your insurance will be that insurance. If a new advisor changes, they just add their name generally to your policy. They might do a review when they meet you to make sure it's still the right insurance for you, but they'll go through the pros and cons with you at that time.
Right. Great. Thank you for joining us once again. If you're interested in our waffle about self-managed super funds, feel free to join us on smsfmate.com.au or search SMSF Mate in Spotify.